Hey everyone, Chris Versace here. Thank you so much for tuning in to this latest episode of the What Does It Mean podcast. We have a very, very jam-packed conversation, Lindsey Bell and myself. You've probably looked around and you've noticed that the stock market has moved into the red so far in 2025, quite the reversal. It's also erased its post-election gains. And for those technical folks out there who are watching the S&P 500 or the NASDAQ composite, they are barreling towards being oversold. Suffice to say, uncertainty, anxiety is permeated the market. But here's the thing, folks, as Lindsey and I will talk about, we are not yet out of the woods. And we would argue that with what's to come, you've got to be mindful before making any moves. And coming up on this podcast, we're going to be talking about Trump tariffs and the responses by Mexico, Canada, and China, why we're listening to what retailers have to say about tariffs, and some of the data that we'll be paying close attention to ahead of Fed Chair Powell talking to the markets on Friday. All that, much more on this edition of the What Does It Mean podcast. All right, Lindsey Bell, good to see you. Sorry about that intro. I was so in the moment that I kind of lost my head. But how are you doing, Lindsey?
I mean, I'm doing all right. Just trying to make sense of all these moves in the markets and all the political tariff news that we're getting. How about you?
I am right there with you. The question that I'm kind of paying attention to is, where are we in the market, right? The S&P 500, NASDAQ composite, like I mentioned, as we're talking, not yet oversold, but we could very soon get there. That kind of sets me up for maybe we'll see something similar to what we saw last August, right? A lot of market pressure, great buying opportunity emerges. But my concern here is, when is that opportunity going to emerge? And I say that because, State of the Union address, we've got a lot more economic data coming, which I don't think is going to be very good. We've got companies that are going to be talking about the impact of tariffs. The Friday employment report, Powell, like I mentioned. Lindsey, I'm looking for good news here. What do you got?
I know. I think that's what investors are grappling with, right? We're all looking for that one data point or the one, person that's going to tell us how things are going to shape up, what growth is really going to look like in the future. And I think that that's going to be really difficult to find, which is unsettling for investors, right? I think what we learned this week is that the risk of tariffs wasn't fully baked into the markets, right? That's why
No.
we've been seeing so much red at the top of the week. I think people were hoping for a last minute deal like we got in February, or a delay, something like that. If you recall, in February, the market was trending down into that deal, but then it rebounded and hit new all-time highs before, these rising fears of global growth or a U.S. growth slowdown really kind of took off.
Well, I mean, you and I talked about this. We didn't do it on last week's podcast because we couldn't have, but wow, that negative revision, back-to-back negative revisions actually, in the land of Fed GDP Now model, I think that really scared some folks. It kind of was like a wake-up call as to, hey, and this is before the tariffs go into effect, right?
Yeah, I think that, along with even the manufacturing data, while on the surface it still was in expansionary territory, what we saw is the new orders. The new orders were pretty negative and prices continue to go up. So the question is that really demand driven, or it doesn't sound like with new orders, or is it really these companies are getting ahead of tariffs? So
Yeah.
I think that's what makes people nervous. I know we're going to talk about Powell later, but it's really this inflation scare too, because it leaves the Fed in a really difficult place. You've got high inflation that's being sticky or stubborn, potentially could go higher, even if it's only temporary, as it typically is in the form of tariffs. But also while growth is slowing and there's this massive uncertainty.
Yeah, I mean, I think ultimately by the end of the week, that could be the question that emerges, right? If the economy is slowing, if layoffs are creeping up, but inflation is, to use your words, sticky, but if we look at the ISM manufacturing PMI accelerating higher, what is the Fed going to do as folks start ringing that word, Lindsey, ringing that bell? Say it with me, stagflation.
I don't want to say it. I don't want to say it out loud.
Well, I mean, look, we to be fair, we do have a bunch of data that's kind of coming, but before we talk about that and what it could mean, how we think it might shape what Powell has to say on Friday, let's talk a little bit about these Trump tariffs that went into effect. To your point, I think the market was kind of looking for a last minute reprieve, but lo and behold, I think coming after that, and I'll say it, you don't have to agree, but I'll say it, that disastrous conversation with Zelensky in the White House and the warm reception that he had with the UK. I wouldn't, my thinking is that really got, Trump's back up and he was going to show folks who's boss, that sort of thing. So I'm not surprised that he went forward with the tariffs, but 25% tariffs on Canada and Mexico, China, another 10%. And here's some data, Lindsay, just to kind of set the stage for that. This group out of Yale, the Budget Lab, they said that those tariffs are the equivalent of a 7 percentage point tax hike, kind of putting the tax rate at the highest level it's been, I can't believe this, 1943, if we go back that far in the Wayback Machine. And they also said that those tariffs will increase average prices paid by people like you and me, somewhere between 1 and 1.2%. For the average household, it's like $1,600 to $2,000. And that's before reciprocal tariffs and before Trump responds to reciprocal tariffs. And we have reciprocal tariffs the White House is studying during the month of March for potential April implications. So, Lindsay, sticky at a minimum inflation, moving higher, I think.
Well, here's the problem though, is like what the market's really grappling with is yes, we were expecting or hoping for a deal, and a deal might not necessarily be off the table, right? And
Hmm.
so
Hmm.
that therein lies the problems. Like, is this the real tariff? 25% on Canada and Mexico, plus whatever is expected to come reciprocal tariffs and other tariffs by April 2nd. Or are we going to reach a deal? Will these tariffs be lower? Will, like we talked with last week with Arthur Laffer about tariffs, is there potential for tariffs to actually come lower than where they were previously? So that's what the market really is grappling with. If we look back at 2018 to 2019, granted, the tariff implications were much smaller than what we're currently expecting or experiencing. But the increased inflation was only a zero point 0.1 to 0.3% impact. It negatively impacted GDP by zero point 0.3 to 0.5% from 2018 to 2019. So the economic impact was less negative than what the market impact or investor sentiment or consumer sentiment may be experienced during that same time period. And so that is where investors are really struggling. And I think that's why the market feels like it's in a free fall right now. Because if these tariffs do stay in place, the numbers that you just talked about could be real. Plus, there's more to come that we don't even know about. And so that impacts earnings, that impacts economic growth much more negatively than the numbers that I talked about. So that's the rub.
Tot Totally agree. That's the rub. Totally agree on that front, Lindsay. But I will say too, though, I think we have to consider that the consumers are kind of in a different place today than where they were in 2018, 2019. I mean, they've been contending with inflation, for some time now. We've already seen, even before the impact of tariffs, inflation was kind of on the move higher. And at the same time, we look at some of those consumer debt levels, man, oh man, they have moved higher as well. So consumers may not have as much to tap. My bet is that we're going to see probably a greater trade down by consumers than what we've seen before. And I think as investors, it means we're going to have to be very mindful as to where they're likely to go, look for where the dollars go, and follow through is what I would say. But with that, it's kind of an interesting time too, right, Lindsay? Because we are only now starting to get that part of the earnings season, the tail end, better known as retailers. And the reason behind that is most of these tend to have January fiscal year end. So you roll forward 45 days, bingo, bango, bongo, as President Trump might say. And here we are in the midst of retailer earnings. And last week we heard from Walmart, we heard from Home Depot. They kind of said, if I remember correctly, that, oh, we haven't really baked in the impact of tariffs yet. I think they were waiting to see what would happen. But now, Lindsay, We're starting to hear from Best Buy. We're starting to hear from Target. What are you hearing?
Yeah, I think it's interesting the timing of these different earnings because when we heard from Walmart last a week and a half ago on February 20th, by the way, that was like the day after the market hit a new all-time high.
Right.
Their CFO talked about the consumer spending patterns as steady and that there's not been any sharp changes in what we've seen. Those are direct quotes from him. But they did talk about we haven't baked in tariff impacts. 2/3 of
Right.
our goods come from the US, but they did give conservative guidance. So in a way, I think in the back of their minds, they were kind of preparing for some of this, even if it's not officially baked into the numbers.
Right.
Because what you are hearing from Target this week, from Best Buy, like you just said, is a much more concerned tone about the impact of tariffs and how quickly those price increases can flow through to the consumer. And so I think again, talking about now is different than 2017 or 2018 when Trump 1.0 put tariffs into place. It's a definitely a different environment from a consumer perspective. Um and consumers do one of two things, right? When prices go up, they either stop buying those goods or they try to replace it with cheaper goods or they simply supplement it with something else. So I think we're going to see if these tariffs stay in place, if they're continue to be escalated over the course of the next month, and we'll be learning more about other items that are to be taxed. Oh, then that you're seeing it in consumer sentiment, right?
Yep.
The Michigan and the Conference Board numbers dropped very sharply in their most recent reading, and part of those surveys, they talked about inflation. The University of Michigan 5-year outlook is for 3.5% inflation, an inflation rate much above the 2% target for the Fed, right? Which means the consumer is buckling down and getting ready for higher rates, and they're going to make spending decisions based on that. And by the way, that also filtered into consumer spending numbers. In the January data. Granted, usually you do see a pullback from consumer spending in
Hmm.
January
Hmm.
after a holiday selling period. Um, but it's just that's why we need more data points in the market. I think it puts the market and investors, consumers, business owners like in this wait and see mode, which isn't good for economic growth.
Oh, definitely not. Because when there's uncertainty, what do? You wait to see what happens. So to the extent that we get more clarity on, what goods tariffs are going to be on, perhaps that facilitates some, better than expected spending. We will see. But just two things I want to follow up on. One, Lindsay, you said bracing for higher prices. Target said we could see higher prices in the coming days, not weeks or months, days. And then on top of that, I don't know if you saw this article, but I'll mention it. You talk about trade down, you talk about replacement. Given the sky high price of eggs, do you know that people are not expected to color eggs for Easter this year? They're buying potatoes and they're coloring potatoes. This is ridiculous. But I mean, just probably the best example of a trade down that you could imagine because potatoes are still relatively cheap.
But they're ugly. They're not cute like little eggs.
I will say that, I've eaten a lot of potatoes, sweet potatoes, Japanese sweet potatoes in my time. You do get some pretty funky shapes, and it's not as, homogeneous as an egg. So I do think folks are going to have a tough time figuring out how to color and decorate these potatoes. Plus, you hide it in the yard. It looks like a rock. Doesn't look like a, decorated egg. It's ridiculous. Um, but we are gonna have some other, retailers reporting, and I think both you and I will be kind of mining their comments, Lindsay. I'm talking Macy's, Foot Locker, Nordstrom's, and I also think that we'll both be paying very close attention to what companies have to say as we embark upon the March investor conference season. Just think about it, folks. We're now, 3.5 weeks, let's call it, to the end of the quarter. Everybody's going to be leaning in. What's the tone of business? But what are they seeing and preparing now for the impact of tariffs on their businesses? My concern, Lindsay, is that we're going to see earnings expectations for really the second quarter and the back half of 2025 really start to move lower. And as that happens, folks are going to sit there and go, that S&P 500 multiple, not as low as I thought it was.
No, I think so. And what you have seen is earnings estimates have fallen more sharply than is typical this time of year for even the full year estimates for the first quarter and for the full year. And so I do think that analysts and, I think that reflects analysts, cautionary tone sentiment as well as CFOs in particular too. So I think that some of it's being baked in, but there's just no this could go either way. There could be more negativity to the numbers, or if we get a positive headline on tariff news. I said on CNBC the other day that if for the market to stabilize or even turn around, for the market to really turn around, I think you just need the narrative on not just, but you need the narrative on tariffs to turn, and that
Mhm.
can really change the outlook for a lot of different things. And I think earnings is one of those things that can at least stabilize the earnings outlook, which, by the way, if you look at fact set numbers, looking for 12%, even after the recent
Mhm.
reduction,
Mhm.
12% earnings growth in 2025. That's not what you see in a recessionary environment. So to your point, does that mean they have to come in more or not? And so,
Yeah. I I think the big word, Lindsay, is going to be duration. How long are these, you know, upsized tariffs on for? But ultimately, and you hinted at this in our, from our conversation with Art Laffer last week that, look, we know that there's going to be pain, right, to get to the other side. It's just a question of how long do we have to slog through before the benefits happen, whether it's a deal or something else. And I will say, I think you're right to the extent that the market does become oversold, it's not going to take a lot to pop it.
right, exactly. So it's the duration and the depth during the duration that we need
Agreed.
to get a better feel on, because if you're an operator, you need to know what that means from your spending perspective. The other thing I wanted to mention too, from the retailer perspective that we didn't cover in the last section was, Walmart and Target both talked about lower profitability,
Hmm.
going at least into the first quarter. And I think that also points to, these are obviously value-oriented retailers, and it points to the price sensitivity of their consumer and the consumers in general. And so I think that it's because you have two choices, right? If you get tariffs, you either push up your prices, which you've heard a Best Buy talk about, and others.
Hmm.
It could Target talk about for some categories. You either push up your prices or you take the hit. And it depends on the industry of the sectors, right? But overall, when you look at the S&P 500, operating margins are expected to reach almost 17%, which would be an all-time high this year. And so they investors aren't going to like it if companies have to take a hit to margins. But if it's in the name of continuing to increase sales, is it something, and ultimately earnings, like, is it something that you can accept? And that's
Well,
not gonna be a comfortable conversation, but,
no, no,
you
no.
know?
And you mentioned a bunch of different companies. I did see right before we jumped on that Chipotle said that they are not going to increase prices, which to your point means that higher input costs, prices staying the same. We got to watch the margin line, and most likely the direction is going to go lower. That probably means a little less EPS, but we'll have to see how it plays out. Now, I joked, Lindsay, earlier that I wanted you to give me something good, but kind of as we sit here and just map out the rest of the week, I don't think there's a lot of good data coming, right? So we've got the ISM Services PMI, we've got the ADP employment report, we've got the February employment report, we got the Fed beige book, and we got Fed Chair Powell coming, and I just, call me cynical, Lindsay, if you want, but I just, I don't see a lot of positive data that can possibly, help the market rally, at least before the end of the week. I think we got to get through all of this data and let the market absorb it. What do you think?
See, I think that the silver lining could be found on Friday. Of course, I don't know how, like, that messes things up, but I think that Friday, you look at the non-farm payrolls coming out, they're expected to be up over 150,000. The unemployment rate expected to stay steady at 4%. Wages expected to continue to grow again at 4.1%, which is what we saw last month, which, fuels maybe inflation conversation. But
Mm-hmm.
I also think it helps to support the fact that the potentially the consumer can, in a way, remain resilient if their earnings are continuing to grow, if they still have jobs. So that's where I'm looking for a little silver lining. Again,
Well,
in
you
this
know,
way,
I
we're
got
in wait and see mode, and we need some good news. You're right.
Yeah, I just I don't think we're gonna get that, Lindsay, and I think the reason for this is, you know, again, take a look. You pointed this out. Let's take a look at the February manufacturing PMI from ISM. Employment contracted. If we see something similar in the ISM services PMI for February, I just find it hard to believe that we're going to have job growth, above 100,000, 150,000, especially given the layoffs that have been announced and what we're seeing, the early, I'm not going to believe I'm going to say this, but the early workings of Doge. So I get a little hesitant, but on the other hand, I will say this. If we see a string of bad data and Powell comes out, once that happens and all the week's bad news is in, if the market is oversold at that point, maybe we see a clawback rally emerge late on Friday into the weekend with the notion of it can't get any worse.
The other thing I would say that I'd be looking for is in a "it can't get any worse" scenario
Mhm.
is really the 10-year yield at, like, 4%. I feel like that, like, the lowering of the 10-year yield has not been a boost to stocks as we had seen prior to the Trump administration. When we saw the pullback in the 10-year, that was like a buy signal, right?
Right,
Uh,
right.
but now it's not. And so
Well,
that's another, I don't know. I'm just throwing that out there.
Well, let me ask you this, right? So yeah, the 10-year has trended lower. The CME Fed Watch tool is pricing in like 3 rate cuts. But you and I watch inflation very closely. I don't think, well, forget what I think. Do you think that Powell is going to blink?
Do I think Powell's going to blink? I don't think so. I don't think he's going to, because I think
Right.
there is way too much uncertainty, because he knows, as we discussed, that like these tariffs, they could change at any minute, And so I think there's that risk. I
Hmm.
think that inflation is sticky again before the tariffs are getting put into place. And if we get decent jobs numbers like I'm anticipating on
Well,
Friday, it it makes it really difficult for the Fed
right.
to cut rates. So
Totally agree. Totally. So, I want to put the microscope on you, Lindsay. If the CME Fed Watch tool says 3 rate cuts, what does Lindsay Bell think for the year? Do we get
I
any?
I I I think it largely depends on what happens, what transpires from a policy perspective over the next couple months. That's not a great
Okay.
answer, right?
No, no, no. So I'll say this, earlier this year before tariffs went into effect, I was in the camp of, 1 to none.
Yes.
And
Me
with
too. We were in
and
the same camp. We were in
yeah,
the
yeah, yeah.
same camp.
No, that's because 'cause you're a smart fundamentalist like me. So as we see these things happening, unless we see the economy really roll out of bed, right? Really fall over. I find it hard to believe that the Fed is going to deliver a rate cut this year. But, the Fed could have a tough if the economy falls out of bed, right? And the second quarter, I think, like again, like we talked about with Art Laffer last week, the second quarter could be challenging as all of this kind of comes together for a potentially perfect storm. Um, the Fed might have some tough decisions to make, but you know, unfortunately, we'll have a lot more data to, kind of chew through and tell us what we think.
Yeah, I mean, let's all just hope that this is a pullback that is a buying opportunity.
Well,
Right.
we will see. So far, I'm inclined to think that, but we will see. All right. When we come back, folks, Lindsay and I are going to share what stood out in our conversation today and wrap up this edition of the What Does It Mean podcast. All right, Lindsay. I have to say that was a really spirited conversation we had today. I'd like it when we don't necessarily agree. I find that we're kind of too like-minded sometimes. So, when we don't necessarily agree, it really allows us to pull out different perspectives, different points that I suspect our listeners find even more helpful. But with that in mind, What stood out to you in our conversation, Lindsay?
Your negativity. No, no, I think well, kind of. I think that our two different viewpoints, not that I'm super optimistic, that I'm trying to be constructively optimistic. Because there is still the current data on the ground is still supports earnings growth and it supports economic growth, in my opinion. So that could change at any moment in time. And I think it really is emblematic of what investors in general are concerned are dealing with right now. It's this tug of war. It's a tug of war between is the world ending, not the world, is the US growth story, US exceptionalism, as a lot of strategists have been calling it out there. Is that story over? Or is it just we've got to get through this tough period of negotiating that the Trump administration is doing to create a more fair environment, trade environment for our country? And so it's hard to tell because you could go either way, right? And so I think it was just really an emblematic debate.
Yeah, no, I mean, I would counter and say I'm not being negative or pessimistic. I'm just being a realist. That's all. I've got to, let the data talk to me, as I like to say. And as I've shared with folks, before, hopium is not an investment strategy. I can't hope that it's going to work out. So, but I do think, though, that your point about focusing on the data and how maybe and we talked a little bit about this last week, but I think you're getting at this again, is that maybe that as investors, we need to be mindful that sometimes expectations can be too negative, right? And that can create the opportunity if we're looking forward to opportunities. I would say I think that's fair. But I also recognize that, man, we've got a lot of stuff to get through this week. Maybe better days next week. That's my sunny side message. How about that? Maybe better days next week.
Maybe because you know why I meant to mention this earlier is investor bearishness reached like extreme levels. If you look at the AII investment survey, and it reached levels that we saw in late 2022, end of September 2022, when we had another growth scare, right? And the market actually bottomed. It also it's not nearly as bad, though, as on a bull bear spread basis from the 2017, 2018 negative sentiment that we had when the first round tariffs were going into place. But anyway, it's at these extreme levels that you could see market bounces to, which is the whole point is it means that this isn't necessarily a situation to get out of the market. It's kind of just review your portfolio and where you're invested, why, does it still jive with your long-term investing strategy, right?
Totally agree. Dust off the investment thesis, refresh your data points, know why you own something. If you can't answer those simple questions, then maybe you should reconsider. I don't know, maybe, but that's a personal decision, I guess. Any closing remarks, Lindsay, before we get out of here?
No, we're gonna be this. We'll be here with you through it all. Check us out next week, right?
Well, yes, Lindsay, we will be back next week. And as Lindsay had to say, we will be guiding you through all this. There's a lot of data, so please be sure to check back. But between now and then, if you need to get more from Lindsay, march on over to Clearonomics, see what she's posting on LinkedIn. If you need anything from me, Chris Versace, march on over to the Street Pro portfolio. Thanks for listening, folks.